Hi there, thanks for stopping by. In today's video, we'll be looking at 3 ETF portfolio to be very wealthy. How to maximize wealth in 2026 and beyond. Before we dive in, if advertisements should interrupt this video, please do not click off of the advertisements. Please allow them to play through as a thank you to me for bringing you this honest, valuable information for free. Now let's continue. If you are watching this, you are not interested in mediocre returns or confusing day trading. You are interested in a clear, strategic path to becoming very wealthy. You want a framework that simplifies your investing life, maximizes your returns, and requires minimal maintenance over the long haul. Today, we are solving one of the biggest problems for serious investors: how to construct a powerful, diversified portfolio that eliminates unnecessary complexity while maintaining aggressive growth potential. We are diving deep into the exact formula for a 3 ETF portfolio to be very wealthy, showing you how to maximize wealth in 2026 and beyond. This is the structure you need to get your money working harder than you do. The confusion around investing doesn't come from a lack of information. It comes from an overload of noise. People constantly chase the latest stock tip, buy dozens of ETFs that overlap, and end up with a complicated mess that underperforms. The truth is, the most successful investors, the ones who truly maximize wealth, use elegant, concentrated simplicity. They use index funds and ETFs strategically. To truly master this, we first need to understand the fundamental mechanics of wealth creation versus income generation. Many people confuse the two. Wealth is built through compounding returns, aggressive growth exposure, and minimizing taxes and friction. Income is generated by selling assets or using tools like dividend funds, which, while great for retirement, often lag in capital appreciation. The goal of this 3 ETF portfolio is pure, concentrated, long-term wealth accumulation. Our entire strategy is built around diversification across 4 essential pillars: US market growth, international developed markets, and emerging markets. The beauty of exchange-traded funds, or ETFs, is that they allow you to instantly own hundreds or thousands of stocks, giving you instant diversification with a single ticker. This efficiency is the engine behind maximizing your returns. So, let's break down the 3 components of this powerful, simplified, and highly optimized portfolio. The first pillar: the unstoppable engine of US growth. The first component, which will form the largest portion of your holdings, is a non-negotiable anchor in the US total stock market. This is component number 1, and its purpose is to capture the vast majority of capital appreciation and innovation generated by the world's largest, most dynamic economy. We are specifically looking at a total stock market ETF, like VTI or ITOT. The reason we choose the total market over just the S&P 500 is crucial for maximizing long-term wealth. While the S&P 500 is fantastic, the total market includes US mid-cap and small-cap stocks. These smaller companies, while volatile in the short term, are the growth engines of the future. They offer an essential factor known as the size premium over decades. By including them, you ensure you are fully diversified across the entire domestic growth landscape, setting the foundation for true long-term compounding. This first fund acts as your primary engine for growth. It should be the lion's share of your 3 ETF portfolio, likely 60% to 70% of your total allocation. This high allocation reflects the historical dominance and regulatory stability of the US market. The key takeaway here is that you are not just investing in 500 companies, you are capturing the entire US economic machine. This aggressive but foundational position is how you structure your portfolio to be very wealthy over decades. It is your non-negotiable anchor for investing in 2026 and beyond. The second pillar, capturing global opportunity and diversification. Now we move to the second pillar, international developed markets. This component serves two vital purposes: diversification and enhanced return potential. Historically, US and international markets rarely move in lockstep. When the US struggles, international markets often outperform, and vice versa. This lack of correlation is your portfolio's secret weapon for reducing volatility and maintaining momentum. For this pillar, we recommend a low-cost, broadly diversified ETF like VA, which covers companies in Europe, Australia, and the Far East. These are established economies with strong currencies and mature markets. By committing a significant portion of your portfolio here, typically 20% to 30%, you are not betting against the US. You are simply ensuring your portfolio doesn't rely solely on one economic environment. You are protecting yourself against any domestic decade of underperformance, which is absolutely essential for anyone looking to maximize wealth globally. This component is often overlooked by newer investors who suffer from home country bias, the tendency to only invest where they live. But when you are building an evergreen portfolio designed to withstand all market cycles, global exposure is the simplest form of risk management. It gives you immediate access to companies like Toyota, Nestle, and Samsung, securing your stake in the world economy. The third pillar, the high-octane fuel of emerging markets. Finally, we arrive at the third pillar, the high-octane fuel of this 3 ETF portfolio, emerging markets. This component, while making up the smallest allocation, typically 5% to 10%, is critical for achieving the very wealthy status. Emerging markets, represented by an ETF like VWO or EM, are the developing economies of countries like China, India, Brazil, and dozens of others. They are characterized by explosive growth potential, rising middle classes, and massive demographic shifts. They have higher risk, yes, but they also offer the potential for disproportionately high returns to compensate for that volatility. They are the true accelerators of your portfolio. In the long run, as these markets mature and integrate into the global economy, they have the potential to deliver returns that significantly outpace developed markets. Allocating just a small percentage here acts as a powerful kicker to your overall returns. This strategic small allocation is what elevates your portfolio from merely being good to being optimized for someone who truly wants to maximize wealth in 2026 and beyond. It is the aggressive growth engine that pulls your entire return profile higher over 20 and 30-year time horizons. The combination is powerful. The stability and size of the US, Pillar 1, the risk reduction of developed markets, Pillar 2, and the high-growth fuel of emerging markets, Pillar 3. This simplified approach is the core of investing in 2026 with clarity. The transformation, execution, and allocation strategy. The true power of this portfolio lies in its execution. We call this transformation-based teaching because it moves you from a passive consumer of information to an active strategic investor. Your standard starting allocation should look something like 65% in the US total market, 25% in developed international, and 10% in emerging markets. This is a globally diversified, aggressive growth stance. The actionable step here is rebalancing. Because the markets are constantly shifting, these percentages will drift. Your US holdings might soar, making up 75% of your portfolio. Your job is to rebalance once or twice a year, selling some of the overperforming asset, like US, and buying the underperforming assets, like international or emerging markets, to bring your portfolio back to your target allocation. Why is this essential? Because you are systematically buying low and selling high, which is the fundamental secret to generating wealth over time. This automatic, rule-based selling and buying is a psychological cheat code that removes emotion and ensures you are always strategically re-risking your portfolio in the areas poised for the next growth cycle. Risk, warning, and compliance alert. We must maintain an objective and ethical perspective. Before you implement this, here's the mistake that could cost you significant growth and dilute your efforts to maximize wealth. Ignoring the expense ratio. The expense ratio is the small fee charged by the ETF manager every year, expressed as a percentage of your assets. Since this 3 ETF portfolio relies entirely on compounding over 30 or 40 years to make you very wealthy, even a small difference in the expense ratio, say 0.5% versus 0.03%, will eat away tens of thousands or even hundreds of thousands from your potential retirement fund. Always choose the cheapest, most broadly diversified ETF available for each pillar. Do not chase slightly higher yields in expensive, actively managed funds. This simplicity and low cost is the key to achieving a truly high long-term net worth. Seek out expense ratios as close to zero as possible. This is a non-negotiable rule for maximizing your return on any evergreen investment strategy. Conclusion: you now have the structural blueprint for a 3 ETF portfolio to be very wealthy. You understand that true wealth creation is built on disciplined, globally diversified, low-cost simplicity. We discussed the 3 pillars: the US Total Market Anchor for foundational growth, the international developed markets for risk-reducing diversification, and the emerging markets for high-octane growth potential. We also established that the key to maintaining this strategy and consistently maximizing your returns is the regular, unemotional process of rebalancing. This strategy is precisely what you need to master investing in 2026 and beyond. The biggest takeaway is this: you don't need 50 different investments. You need a few powerful ones used strategically. This is the difference between a complicated hobby and a powerful, low-maintenance wealth machine. If you found this strategic breakdown valuable, please let me know by leaving a comment below. What allocation split are you currently using? Your engagement helps us deliver more high-value, actionable content like this. Don't forget to subscribe to the channel and hit the like button. It ensures you don't miss our next strategic deep dive on maximizing wealth and financial independence. Thank you for watching, and I'll see you in the next video.